Hi all. Today we are going to see a live example of option pricing. So we have seen a bit about Black-Scholes-Merton model, how to price an options and how to interrupt the outputs from the Black-Scholes-Merton model, which are nothing but the delta, gamma, and other Greeks. Today we'll see the live example from the Indian stock market's perspective, which is nothing but the Nifty as an index. The Nifty is nothing but here it's an Indian benchmark. So we are going to price an option for a particular option. I think we can price a call option. So before going into that, so this is predominantly uh, I would say this is the option chain. You can see in the picture. On the right hand side, you can see it's the put option live data. So this is the strike price, which is ranging from 8,300 to 12,100, and you can see the live order book, that is nothing but the bid quantity, bid price, ask quantity, ask price, last traded price, which is nothing but the liquidity. It's a very good understanding on the liquidity risk too. So on the last traded price, so and also the implied volatility numbers, you get each and every data at a single screen across strike prices from the option chain perspective. So on the right hand side it is a put option, on the left it is a call option. So all we need to know for an option pricing is, as we have seen earlier, we need stock, strike, volatility, risk-free rate, and other factors, right? So predominantly the spot price is 12,080 as of 2020, and today is 2320. Since Saturday and Sunday are all day, tomorrow the markets will open. So we are going to price an option which has an expiry, the time to maturity of 1 month over time, which is nothing but the 26th March. Okay. So the strike price is 12,100. We are going to price the strike of 12,100, and the spot price is close to 12,100 too. Just we have seen, which is 12,080. So what is the live price in the market as of today? The live price in the market, which is nothing but the last traded price, for the call option is 184 rupees, which is dropped from day on day basis. You can see the bid and ask price. The bid is 182 and 184 is the ask. The bid is the price which they are going to pay, and 184 is the price which they are going to sell it, right? So we are going to price this option. Before pricing the option, as I said earlier, we need the input factors. Once we feed the input factors such as stock, strike, data, we get the output. What we get as an output, we get the price as an output. In addition to that, we can know the important Greeks data. What are Greeks? Delta, gamma, and other Greeks numbers. So which are helpful in analyzing what happen to the option prices when the underlying prices moves in either of the direction, either on the upside or either on the downside. So what happens to the option prices? We get a good understanding. So just to repeat again, we are going to price the option, which is the call option. The spot price is 12,080, and the strike price which I have chosen is 12,100, and the live option price is 184. You can see this is the option price which is traded in the market, driven by the liquidity, which is nothing but the bid and ask. The bid is 182 and ask is 184. This is just for an understanding purpose. This is the live market premium. So every day this premium changes. This premium is not stagnant. It changes on each and every day. Okay. So let me go quickly into the options calculator. I have opened the option calculator readily at my place. So let's see, when we have the input factors ready, so it's loading. So before gets loaded, let's quickly see, this is the form. I would say these are all the granularities which needs to be filled. I mean to say these are all the input variables which we need to input in the Black-Scholes model engine. Then only we will get the price. So when we input the wrong numbers, as we all know, garbage in, garbage out, so we get the wrong outputs. So predominantly the input should be very clear, then only we get the right output at place. Okay, so let's see what we are going to price. So we are going to price the Nifty option. So before that, we need the symbol, we need the spot price, we need expiry, we need strike price, we need option, and we need and we get the premium. Okay, and we can calculate the option price too. So let me try to input the option. So I'm searching for the spot. Okay, so this is the stock. Let's, to make it simple, let's treat it as an stock. So this is the stock where I'm going to trade the option. Okay, so option calculator. So the Nifty is the stock. I'm going to fetch the underlying price. So what is the underlying price? We got it readily. It's 12079. Our strike price is 12,100, but we need to change the expiry. It is not. Uh, it's not 1270. It's 26 March, right? So what is the evaluation date? The evaluation date is 24th February. That is the date where we are valuing the option as of today. So we need the volatility. What does this volatility number mean? This is nothing but the historical volatility of the underlying. The underlying here is Nifty. It's not the options volatility. If for options volatility, we call it as implied volatility. For the option pricing, we need the historical volatility of the underlying. I somehow know the historical volatility of Nifty. I mean to say the underlying is somewhere close to 14 to 16%. So let me plug in the 14.5 and let's try to price the 12,100 call option. So here we got the output. Okay, we got the output. One is for call, one is for put, and we have seen in this example, we can we already seen here from the live option chain, the market price of the option is where it is 184. It's close to 184. From our model we got the price of we have gotten the price of close to 194. The 194 is the price which we have got. So the reason is, I would say it's almost close to the live option price. So if there is an arbitrage opportunity, so what does this arbitrage opportunity in the sense, when the when the Black-Scholes model gives you the value more than the market data, market rate, live rate, then there is an arbitrage opportunity for you to buy this option. When the price is high, then you can short the option. But in actual case, since Black-Scholes model is predominantly used in majority of the population, the option mispricing is very rare. The reason for this difference is there might be some difference in the since our historical volatility is not precise. Of course, there is some mispricing. So that's the reason the option price is more by $6. So that is fine. So we can see it's, I would say it's a point to point perfect. So the price is 183, 193. The volatility is 14.5%. That is our historical volatility. And the delta is 0.49. So as you can see here, what does this delta means? The delta of 0.49 means here, since this is an at-the-money option, what does that at-the-money option means? The strike is close to the spot. So in this case, this is an at-the-money option. So the delta is 0.5. So since we are at the middle, exact middle, we are not above the strike price or we are not below the strike price. So there is only a 50% chance that we'll be expiring in the money. I mean to say our strike is less than the stock price, correct? Then only when the stock is above the strike price, then we'll be sitting in profits, then option will be exercised, correct? So this is one way to interrupt the delta. The second way is, if the stock is moving $1 on the upside, we'll be making 50 cents on the upside. So that is the second interpretation on the delta sprint. So coming right back to the next column, which is nothing but the put, you can see the exact opposite. So when the stock is rising $1, since put option we make money only when the stock goes down. Here we are losing money, which is nothing but the 0.5. So it's very simple. Just try to get it. So everything will be in place on the exam perspective. So what is theta? The theta here is 0.3. Since these are at the money option, as I told earlier, this are not in the money or out of the money. Since they are at the money, since they are close to the stock price, this doesn't have any intrinsic value. It has only the time value. So when they have only time value, this value needs to be data rate. I mean to say it needs to reduce over time. I mean that is, in this case we have 1 month to expiry. So in this case, if the stock is not moving in any of the direction, the stock price needs to be reduced on the daily basis. I will do one thing. I will change the evaluation date. I mean to say the stock will be at the same place on Wednesday too. Let's see what happens to the option prices. You can see from 200 and some 196, it came down to 186. The reason is all other factors are constant, but the time has reduced. When time is reduced, our option has reduced in value. That's the reason our option has reduced in value. Okay, so now we can see that now the delta is clear, theta is clear. The theta is very clear because theta is nothing but the time decay factor. When the option is at the money, in the money, or out of the money, when the value which is more than the intrinsic value will decay over time. Okay, so what does volatility means? So the Vega factor is nothing but the volatility numbers. When the stock price is say if the volatility number is rising from 14.5 to 15.5, our option price will change by $15. Exactly. It has changed from 185 to $200. That is what it signifies. Say for example, our volatility came down from 14.5 to 13.5. Our option price will reduce from 185 to 173. It's almost close to 15. That is the reason. So we have seen here while it is raised, it raised to 15 exactly. When it fall only 12. What is the reason? That is due to the convexity factor. That is due to the convexity factor and also the time value factor. We will see more about that in detail. That is our core deep concepts. As of now, delta is clear, theta is clear, vega is clear. Try to make it simple. I hope this helps. And gamma, it's nothing but how much our option price, how much the delta will change. So if delta measures how much option price is changed, something needs to be there. How delta is going to change. So that is measured by gamma. So the rho is nothing but the market interest rate. Unfortunately, this model, they have outcoded the market interest rate. So the market interest rate, say for example, it's a live RBI rate or Fed funds rate. They have outcoded it somewhere. So that's the reason we are not able to tweak the variables. I mean, I am not able to change the variables. Otherwise, I would be able to do it. So it is also the same understanding. The market interest rate is rising by 4%. Our option price is going to rise by 4%. The reason is this have a positive correlation. Just to repeat once again, if you need to buy the underlying of this Nifty in this cash market, we need to pay 12,100, close to 110 of the million in the cash market. The cost of funds is somewhere around 4%. Say if it is 8%, it is doubled from 4% to 8%. The cost of funds is now doubled from 4,000 to 8,000 rupees. Okay, so if it is an option, as we all know, we are not going to pay the entire amount upfront. We are going to pay a very small amount, that is 173. You can see the spot is 12,000. You can see we are paying not even a 2%. So in this case, there is no point of cost of funds. It's very meager. We can mitigate it. So that's the reason when the cost of funds are high, the people always prefer call options over the underlying. I mean to say here, the underlying stock, which is nothing but the Nifty here. So that's it for today. I hope it is very clear. So that's the reason I have made it very simple. So just post in comment or subscribe or share it to your friends if someone like it. I think this will be predominantly helpful. Just get a very good hang of it. If you have a very good control on it, this is a cakewalk. But these concepts are very fundamental and it will be lays a foundation for part two or in the live trading. Without this knowledge, I would say this is the ABCD of the derivatives. I would say these are not even advanced. These are the ABCD of derivatives. Please try to understand. I hope everything is will fall in place. Thanks all. Have a great time. Thank you.